Some traders consistently win while others keep taking losses, even when they're looking at the same charts. The secret is simple: mastering high-probability setups and knowing exactly when to enter and exit a trade. And that's exactly what we're covering today. We're diving deep into the smart money concept, breaking down the key criteria for spotting high-probability setups, and more importantly, how to filter out risky trades that can hurt your success rate. But that's not all. I'll also show you different entry and exit strategies, the pros and cons of each, and how to make smarter decisions in the Forex market. We always appreciate your support, so please give this video a thumbs up and subscribe to our channel if you are new. Welcome back, traders. So, let's get started. One of the essential steps in trading is identifying a high-probability trading setup that maximizes your chances of success. To filter out setups with high-risk exposure, it's crucial to follow specific criteria step by step. Now, imagine the market's general profile is bearish, and we're looking for a selling opportunity. Here are the top rules and guidelines to help you easily find the perfect trading opportunity. Rule number 1. Price must originate from a higher time frame supply or demand area. First and foremost, we need the price to come from a strong supply or demand zone on a higher time frame. In this case, price is in a strong downtrend and has already reversed from a strong supply zone on a higher time frame, which signals potential selling pressure. Number 2. Price needs to fill fair value gaps. We look for the price to fill any fair value gaps. Here, the price moved back up, filling those gaps created during the previous downward move. This also swept internal liquidity, clearing out orders inside the range, which set up the market to target external liquidity. Number 3. A liquidity sweep must occur. The third rule is that we need to see a liquidity sweep, either buy side or sell side. On the chart, we can clearly see that the price swept liquidity above a previous high and then quickly dropped back below it. That's our liquidity sweep pattern. This also creates a new supply zone, giving us a solid reason to consider going short. Why is this important? Well, after clearing buy-side liquidity, the price often gets pulled towards sell-side liquidity, which aligns perfectly with the downtrend. Number 4. Price must be in the premium zone. To take a sell position, the price should be in the premium zone, which means above 50% of a Fibonacci retracement. Looking at this setup, the price is definitely in that premium area, making it a favorable spot to go short. On the flip side, if you're considering a long position, the price must be in the discount zone, which is below 50% of the retracement level. Number 5. The presence of a higher time frame liquidity zone as a target. And finally, we need a higher time frame liquidity zone in front of the price to serve as a take-profit target. That gives us a clear destination for the trade. When all these rules and criteria align, we have a high probability trading setup. But here's the catch. The biggest challenge traders face isn't just finding that perfect setup. It's knowing how and where to enter the trade. This is the most critical and tricky part of trading. Why? Because even if you've identified a flawless setup and accurately predicted where the price is headed, a poorly timed or misplaced entry can still lead to losses. Nailing your entry point is what separates consistent traders from those who keep getting stopped out. Now let's dive into the possible smart money concept entry methods step by step and learn how to use them to identify the best entry points in the market. There are 3 main entry setups. The first one is the aggressive entry model, which carries more risk. The second is the conservative entry model, which offers entries with additional confirmation. And the third is the ultra-conservative model, which provides a setup with multiple confirmations across various time frames. Each model has its pros and cons, so choose the one that best matches your trading style and risk tolerance. Now let's get started with the aggressive entry model. Executing a trade using this entry model is like placing a limit order within the higher time frame's demand or supply zone. Imagine we have a perfect sell setup, like the example on the chart, confirmed by the criteria and rules of a high-probability trading setup. For placing a short position using this entry model, your entry point should be right at the lowest point of the supply zone. To manage risk effectively, set your stop loss a few pips above the highest point of the zone. When it comes to take profit, you can target the closest external liquidity at the same time frame, as we anticipate that price will move in that direction. Alternatively, you can aim for the higher time frame's major liquidity zone to achieve a higher reward-to-risk ratio. Risky entries come with their advantages. You're less likely to miss trading opportunities, and you don't have to constantly monitor the charts. However, there are drawbacks to consider. It provides higher risk, because you've entered into the market without a reversal confirmation, and also, you're not watching the price reaction when it reaches the area of interest. For instance, consider a situation where it coincides with the London-New York crossover, and a news event causes volatile price movement. There's a high chance the price hits your stop loss, and then starts moving down. Since this entry method involves a larger stop-loss area, it obviously provides a lower reward-to-risk ratio. Now let's move into the conservative entry model details. In this entry model, we employ two different timeframes for our trading approach. A higher time frame for market analysis, and a lower time frame for entry confirmation and order execution. I prefer using the 15-minute time frame for market analysis, and then switching to the 1-minute time frame for executing my trades. However, you have the flexibility to choose other time frame combinations, like the 1 hour and 5 minutes, or the 4 hours and 15 minutes, depending on your preference. The key principle to remember is that your market analysis time frame should be at least twice as long as your entry time frame. To apply the conservative entry, we should wait for the price to tap into the area of interest and show a rejection. Then our next step is to switch to a lower time frame. Closely monitor the price movement and patiently await the formation of a valid change of character pattern. After detecting the confirmation of market structure shift on the entry time frame, we can set our entry position on the lowest point of the newly recognized order block, in this case, a supply zone on the lower time frame, which is created by the change of characters wave, with a stop loss set a few pips above the highest point of the zone. And for the take profit, we set it at the external liquidity of the higher time frame. The pros of this entry setup are that it ensures a reaction at the area of interest by closely monitoring lower time frame price action. This results in a higher reward-to-risk ratio due to the use of a tighter stop loss on the lower time frame. However, there are cons to consider. If the price decides to flip the identified area of interest and continues its upward movement, your stop loss placed on the lower time frame may get hit. Because by using this type of entry, there's also the possibility of a continuation flip pattern forming on the higher time frame. Or if the price requires more buy-side liquidity to be swept, using this type of entry may trap you in the market. Another drawback is that you're more likely to miss out on trades if you refine your entry zone too much. Now let's dive into the third entry setup, the ultra-conservative entry. Imagine we have a perfect sell setup on a higher time frame like the 4-hour time frame, which is confirmed by the criteria and rules of a high-probability trading setup. Our next step is to switch to a lower time frame like the 1-hour time frame, closely monitor the price movement, and patiently wait for the price to return to the higher time frame supply zone and demonstrate a change of character pattern. After detecting the confirmation for market structure shift on the 1-hour time frame, to apply the ultra-conservative entry setup, we need to follow a few steps. First, we should identify and highlight the supply zone generated by the change of character's bearish wave. Then, we need to zoom into a lower time frame like the 15-minute time frame, and patiently wait for the price to tap into the identified 1-hour time frame's supply zone to get reversed from it and create a new change of character on the 15-minute time frame. Our next course of action is to identify the order block generated by Chalk's wave in the 15-minute time frame. In the next step, we should zoom into the 1-minute time frame and wait for the price to enter into the 15-minute time frame's supply zone to get reversed from it and show a change of character pattern. Once the change of character is confirmed in the 1-minute time frame, we proceed to identify the order block attributed to the change of the character's wave. Subsequently, we place a sell limit order at the lowest point of the zone, with a stop loss set a few pips above the highest point of the zone. As for the take profit, we have the option to target the unmitigated demand zone on the higher time frame like 15 minutes or 1 hour, or the swing low of the current time frame. These steps will help us execute an ultra-conservative entry with a well-defined risk-reward ratio. The ultra-conservative entry model has its advantages. It utilizes multiple time frame reversal patterns for trade confirmation, significantly boosting the likelihood of successful trades. Moreover, it offers a more favorable reward-to-risk ratio by meticulously refining entry points on lower time frames. However, there are notable cons to consider. First, this approach demands more time for monitoring price movements across various time frames. Additionally, seeking extensive confirmation before executing trades might lead to missed opportunities, even if prices move in the anticipated direction. Another downside is the potential to miss many trades when overly refining the entry criteria. Now that we've fully covered all the entry setup options for placing buy or sell positions and gained a solid understanding of them, let's move forward. Imagine we've identified a high-probability trading setup on the chart that aligns perfectly with all the criteria and rules we've discussed. The next step? Finding the optimal entry point and, most importantly, getting involved in the market. But before you execute any trade, there's a key factor you must always consider: invalidation. Invalidation refers to the conditions or elements that could prove your trading setup wrong, potentially turning it into a losing trade. This applies even to setups that seem perfect and highly probable. If you spot any signs of invalidation, anything that suggests the market might not behave as expected, it's a clear signal to stay out. Remember, successful trading isn't just about finding great setups. It's about knowing when not to trade. That's just as important as knowing when to pull the trigger. So, what factors can cause the invalidation of a trade? Let's start with the first and perhaps most critical factor. 1. The time of day. Imagine you've spotted a flawless setup. Everything aligns perfectly with your trading plan, offering a high probability of success. The price is approaching your point of interest, and you've set a small stop loss, making it an ideal opportunity. But here's the problem. The market lacks the momentum and liquidity needed to support your trade. This often happens during quieter sessions, like the Asian session, or during low activity hours around 12 p.m. or 5 a.m. Without enough liquidity, trades are less likely to play out favorably, reducing your chances of success. To trade successfully at the right times, you need to know how the market acts during different parts of the day. Each part has its behaviors, like how things move in Asia, or when London has reversals or fakeouts. Also, pay close attention to session overlaps, like when London and New York are both active. These are often the most volatile and favorable trading times. If a setup occurs outside the optimal trading hours, we simply choose to refrain from trading. Timing is everything in the market, and trading during periods of low liquidity can significantly reduce the success rate of any setup. For the London session, the most optimal time for trading is generally during the first few hours, 8 a.m. to 12 p.m. GMT. This period often sees the highest liquidity and the most significant price movements. Many traders prefer to start trading when the London session opens at 8 a.m. GMT, because this is when markets tend to set the initial direction for the day. Major economic data releases related to the European economy are often scheduled during this session, which can lead to increased volatility. The most optimal time for trading during the New York session is typically during the overlap with the London session, 13 to 17 GMT. This overlap often experiences the highest trading activity and liquidity. The first few hours of the New York session, 13 to 15 GMT, can also be favorable for trading, as this is when U.S. economic data is released and can result in significant price movements. It's important to note that after 17 GMT, liquidity can start to decline as the New York session winds down. I prefer to not trade after 5 p.m., because particularly after that, most likely price will consolidate around the major zone that has been formed through the day until the London session starts tomorrow. And for the Tokyo session, the most optimal trading time during this session is generally during the overlap with the London session, 8 to 9 GMT, as both sessions see higher liquidity and potential for price trends. 2. News and economic events. The next crucial factor to consider is news and economic events. These are key drivers of price movement in the Forex market, and can trigger sharp spikes in volatility. Forex markets often experience increased volatility around the release of major economic data or high-impact news events. This can cause sudden and unpredictable price fluctuations that may invalidate even the best trading setups. What to watch out for? If a high-impact news release or economic event is either already released or scheduled near your point of interest, it becomes risky to enter the market. Why? Because such events create significant surges in liquidity and heightened volatility, which can easily disrupt price action and lead to unexpected moves. Stay informed by keeping an eye on economic calendars to know when major announcements are expected. Adapt your trading strategy based on your risk tolerance during these events. What I highly recommend during a news event is to wait patiently for the excitement and volatility created by the event to settle down. Then, assess the situation and look for potential entry points. Avoid using pending orders like sell or buy limit orders during a news event. Remember, timing is critical in trading. Staying alert to market-moving events can protect your capital and improve your decision-making. Third, sudden and rapid push into an area of interest. Price behavior near the area of interest is critical when deciding whether to proceed with a trade. Why this is a red flag? Imagine the price suddenly gains strong buying momentum and moves directly into your bearish AOI, where you plan to enter a short trade. In such a scenario, you should reconsider using that zone as your AOI and avoid placing trades there. A sudden, massive move toward the AOI could sweep buy-side liquidity, pushing the price even higher. Turn your AOI into a source of liquidity, rather than a reversal point. Increase volatility and decrease the reliability of your setup. When the price makes a rapid and aggressive push into your AOI, it's often best to stand aside and reanalyze the market conditions before taking any position. Fourth, fundamental factors. Lastly, fundamentals are a significant consideration that can invalidate technical setups. Fundamentals provide context for understanding market forces and long-term trends. They help traders manage risk and adapt to changing market conditions. Risks of ignoring fundamentals? Missed long-term opportunities. Increased vulnerability to news events. Inefficient trading. Adaptation challenges. Always complement your technical analysis with a fundamental understanding of the market. This dual approach improves your trading precision and helps you navigate complex market environments more effectively. That's it, traders. Thank you for watching this video. I hope you found it informative and useful. Don't forget to hit the subscribe button and turn on notifications to stay updated on our latest videos. We value your feedback and suggestions, so please leave your comments below and let us know what topics you'd like us to cover in our future videos. We appreciate your support and look forward to seeing you in the next episode.